So you started investing and you love the idea of passive income. You just came across the JP Morgan NASDAQ Premium Equity ETF and saw a 9% dividend yield. Actually, currently 11.55% dividend yield. Seems like a steal. But let's dive a bit deeper and see if this ETF should make it into the portfolio. It's your favorite investor, and this is a channel to help keep you invested and build your wealth. JEPQ, or the JP Morgan NASDAQ Premium Equity ETF, has a trailing 12-month yield of 11.65% and currently pays a monthly dividend and has a dividend rate of $5.63. This means that for every share of the ETF that you own, you will get paid $5.63, with a share price at the time of this video of $48.41. That's a pretty good rate of return in your cash. But it seems too good to be true. So what gives? Well, this ETF doesn't own dividend paying companies. In fact, it owns non-dividend paying companies such as Google and Amazon. It is able to pay such a high yield in its holdings by using options premium. Through a combination of covered calls and cash secured puts, they're able to generate cash flow for holders of the ETF. Not only that, but because it holds some of the top components of the NASDAQ, it will also see some nice price appreciation because of its underlying stocks. To put this into perspective, the stock has seen a price appreciation of 18.86% this year to date. So is this ETF a yield trap? To answer this question, we will have to look at the holdings and the purpose of the fund. Offering such a high yield and not having much of a history to go off of is a very difficult task. However, we know that JEPQ holds great companies and an underlying index fund that is growth based. This would imply that JEPQ can not only see explosive growth, but it can also see extreme periods of drawdowns. However, due to the fact that it pays a dividend based on selling options premium, it helps mitigate the volatility by returning cash flow to investors during periods of uncertainty. Options premium will get paid whether we are in a bull market or a bear market. Options premium are also higher when implied volatility is higher. This fund is very different to something like QYLD, another income ETF. However, this fund consistently underperforms in share price, leading your capital to depreciate over time. I do not believe funds like JEPQ will see this type of performance. The biggest reason being that it holds companies long term and doesn't write options on 100% of the portfolio. QYLD writes options on 100% of the portfolio, which does not allow the ETF to move significantly with the indices during bull markets. It also doesn't hold any companies because it's using the entire 100% of the portfolio to sell options premium. A better comparison to JEPQ is the QQQX. This ETF is very similar to JEPQ, however, it has a longer track record. We can see that during the last 10 years, the QQQX has just slightly underperformed the S&P 500. However, for dividend investors seeking income, you would have been obtaining your distributions like clockwork. So look at your goals. The purpose of a fund like JEPQ is to attain income now so that you can do as you please with your dividends. You don't have to sell shares to realize profits. If your focus is dividend growth, this fund will probably not see that consistently. Options premiums fluctuate, and so your payouts will vary because of that. A fund like JEPQ will rely heavily on market environments being favorable to capitalize on options premium. Unlike a traditional blue chip company that will continue to pay dividends as long as the cash flow of the company and overall health remain on a steady upwards trajectory. In my case, a fund like JEPQ has made its way to my portfolio as a way to take trading profits and a small amount of investing capital to build consistent monthly cash flow. I don't expect the payments to change dramatically. I do believe in tech, and I believe JEPQ will see some decent price appreciation while providing me more income to do the things I love. If you plan to add this to the main portfolio, make it a small part to complement your other holdings. Something like the S&P 500 is the benchmark, and although I believe some years JEPQ will outperform, I do expect this ETF to have its down year. In my opinion, it should not be the only holding in your portfolio, especially if you have more than 10 years of investment to retirement. 10 years is a long time, and a lot of compounding can happen in markets that you want to be exposed to. I believe if you truly believe in tech and its ability to perform well, you will probably see a better return on your investment by going with something like the QQQ or XLK. Of course, if you're after income, JEPQ may be a good option that should hold or appreciate in value over time. Anyways, if you've made it this far in the video, I hope you got some value from it. And be sure to check out the bestdividendcalculator.com to start putting together your plan to build wealth. Link down in the description. As always, thank you for watching, and be sure to hit that like button and subscribe for more financial content. It's your favorite investor, and I'll catch you on the next one.